Most people think tax savings come from buying things they don't really need or chasing deductions that they don't fully understand. That's not where the real leverage comes from. The biggest tax savings don't come from spending more. They come from structure. And once structure is in place, the tax codes start working differently. And that's what this next move is about. Most people earn money all year round and panic at tax time. They ask, what can I deduct? That's backwards. The real question is, when does this deduction matter most and why? Once structure is in place, timing becomes leverage. That's where this move lives. In this video, I'm going to show you how the tax code quietly rewards ownership, planning, and timing, not by accident, but by design. By the end, you understand how a few structural rules can move real money without changing how hard you work. Let's start with one of the cleanest rules in the tax code, the Augusta Rule. If you own your home, you're allowed to rent it to your business for up to 14 days per year. Here's what matters. The rent is deductible to the business. The rent is tax-free to you personally. No depreciation, no Schedule E, no income to report. That's not a loophole. That's not optionality. That's the law. Let's keep the math easy. Your business rents your home for planning meetings or strategy sessions. You charge $1,000 per day for 10 days. That's $10,000. What happens? The business deducts $10,000. You personally pay zero tax on it. At 30% combined tax rate, that's roughly $3,000 saved from just one rule. No new expense, no income gains, just structure. This only works if the rent is reasonable, the meetings are real, the documentations exist. This is not a personal event disguised as business use. People who use this correctly, they document it and they moved on. Timing is the real lever. Deductions don't matter equally every year. A $10,000 deduction in a low marginal rate year might save you $2,000. That same deduction in a high marginal rate year might save you $4,000 or more. Same expense, different impact. That's timing. People who plan ahead, they do it differently. They accelerate expenses into high income years. They delay income when possible. They stack deductions when marginal rates are at the highest. They don't ask, can I deduct this? They ask, when does this deduction matter most? When is it most impactful? You already have income structured properly. Income shifted to a lower brackets by hiring your children into your business, a home office in place, and timing strategy actually amplifies all of it. It's not saving you hundreds anymore. It's saving you thousands repeatedly. So for most business owners using this correctly, the Augusta Rule will save you about $5,000 to $10,000 plus. And the timing strategy is about $3,000 to $10,000. So if you combine that, that's about $8,000 to $20,000 per year, depending on income and structure. Not magic, just math applied at the right moment. Once the structure and timing works together, the next question becomes obvious. What happens when the business moves? Travel, transportation, logistics. That's move number 5, business travel.